Is it worth having an international index fund in your investment portfolio, like a 401k, Roth IRA, or a taxable brokerage account? And I want to share some of the research I found, but if you're expecting me to say yes or no to the international fund, you're not going to get that from me because you need to make your own financial decision. I don't know anything about your finances, so you have to make your own investment decision based on your risk, opportunities, and exposure.
You know what you have to do.
And so far, in 2024, at the time I'm recording this video, the S&P 500 is up over 7% year to date. Just in 2024, the small cap index fund is up over 3% in just 2024, and the international fund is up over 2.5%. And I have this tracker and many other investment calculators that you can use for absolutely free by visiting firesightshare.com/resources. This tracker is specifically for the TSP index funds, which get updated on a daily basis. The right side here tracks the target date retirement funds or the life cycle funds, but you can see here that the international index fund is underperforming both C and S funds, or the S&P 500 and the small cap index fund. So if you ask your financial advisor or financial planner on why you should include an international index fund to your portfolio, their answer is going to be diversification and risk management. But the lingering question almost everyone has is the past performances of the international funds, because they have been underperforming the US stocks for many years now. So does the international market have some potential to make some gains in the next 5 to 10 years? There are developing markets in the UK, Japan, Australia, Canada, and other countries. There are emerging markets in countries that have developing capital markets and less stable economies. Guyana is a perfect example of an emerging market ever since they discovered 11 billion barrels of oil off their coast. The discovery of that oil is going to change Guyana's economy forever because they're going to have the revenue to reinvest back into their people. So let's take a look at the comparison between the US stock market and the international stock market index fund. On the left side here is the US total stock market index fund. And on the right side is the international stock market index fund. In 2023, the US stocks performed a 26% return, while the international stocks performed a 15.5% return. That was a tremendous bull market year, but the international stocks still underperformed US stocks. In 2022 was a bear market year. It was ugly, right? When we saw the craziest inflation rate in the last 40 years. But the international market actually had smaller losses than the US stocks did. So depending on how your portfolio is diversified, you would have had a smaller loss if you were diversified with international stocks. And if you take a look at the 3 bull market years between 2019 and 2021, the US stocks performed an average of 25.8% return annually, while the international stocks only performed a 13% average annual return. Now, 13% is still good, but it's just not as good as 26% with the US stocks. And I've been investing for a long time despite my look, and I'm actually a lot older than you think. It was in 2014 and 2015 when a lot of retail investors got very frustrated with the international market when it had back-to-back negative years, while the US stocks performed in the positive. And I don't know if you're as old as I am, but I remember when my target date retirement fund was really lagging behind the benchmark like the S&P 500. 2015 was especially a rough year for the stock market, despite finishing the year completely flat at 0%. The market was actually doing pretty decent until June or July when the market dipped pretty hard. The international market, on the other hand, started to dip even more. So it was frustrating to many investors who were trying to beat the market back in 2015. The only 2 years when the international stocks beat the US stocks were in 2012 and 2017 in the last 13 years. 2012 was especially a good rebound year after the 2008 to 2009 global recession, especially right after the negative 14% return the year prior in 2011. And if you look at the two comparisons, it's pretty obvious that the international stocks have severely underperformed the US stocks. The retirement investors with a 401k, Roth IRA, or other retirement accounts with a long time horizon are troubled to see how the international stocks are only performing a 5% average annual return in the last 5 years and only 4.4% in the past 10 years. And keep in mind that these are the funds that are inside the target date retirement fund. So having those target date funds in the portfolio actually made it underperform the S&P 500 or the US total market index fund in general. And let me show you the 2050 life cycle fund, for example. And this one has over 28% of its portfolio in the international fund, or I fund, as it says it right there at the bottom. This means that you have 28% exposure to international markets inside your investment portfolio. So if your money is invested in this target date retirement fund, you're already diversified between the US stocks and international stocks. If you're not a fan of the target date retirement funds because you like to choose your own index funds, Vanguard still recommends that at least 20% of your overall portfolio should be invested in international stocks and bonds. But having 20% of the international fund has made the portfolio grossly underperform the S&P 500 index fund. So is Vanguard still right about the 20% recommendation? By the way, did you know that over 50% of Americans who make over $100,000 a year are living paycheck to paycheck? So is it always an income problem or a spending problem? If you're having trouble figuring out your budget, I encourage you to download a budget app called YNAB. YNAB stands for You Need a Budget. That's right. Whether you make $50,000 a year or $200,000 a year, every one of you needs to create a budget to achieve financial independence. You need to give every dollar a job so that you can be more intentional with your savings and spending. You can get a free trial without any credit card information by using the link in the description below. Now, hedge funds and many investment firms have admitted that getting their clients to buy international stocks have been a hard sell for many years now. Some investment firms have argued that international stocks are attractive because of their low valuation. Are they wrong? Not necessarily, but it's a hard sell regardless because of their past performances, right? Does the recent performance mean the international stocks are going to perform better than the US stocks in the future? Well, let me show you what Fidelity is actually arguing right now, and you can take it with a grain of salt, okay? And Fidelity is taking the global growth and innovation into their investment consideration. Now, I'm going to put this article and link in the description below, but to summarize it, Fidelity wrote some research points to international stocks potentially outperforming US stocks over the next 20 years. Their argument is that many foreign countries' economies have long-term growth prospects. They also saw a surprising growth with Japan, and consumer spending in Japan and market reforms contributed to Japan being one of the best performing stock markets in the world in 2023. And Fidelity thinks that international stocks will outperform US stocks over the next 20 years with even more mature and developed markets in Europe and Asia. Fidelity also mentioned countries with an emerging market. Remember, an emerging market is a country that has indications of a developed market, but it is not yet fully developed yet. And they're in the developing phase on the way to the developed phase. Does that make sense? And you could argue that a country like Vietnam is in a developing phase while India is close to becoming a developed phase. In other countries like Indonesia and Brazil, Fidelity thinks that they're overlooked and have the potential to become a major source of economic growth and profits for both the US and international companies over the next 20 years. Apple, for example, is moving its labor market from China to India, and there are other tech companies moving more to India and other countries to continue their growth. But there are risks involved in this because geopolitics are always the biggest concern. And Russia's invasion of Ukraine, China's nationalistic policies that are hurting international businesses, and the continuous conflicts in the Middle East are making investors hesitate to invest in international stocks. Not to mention that inflation is still a problem in some countries in Europe and South America that may force companies to reduce their spending. So many investors like me are looking at emerging market stocks or EM stocks as something more volatile and not guaranteeing a profit in the short-term future. And I think it's going to take the international stocks to really start outperforming the US stocks in order to invite more investors to take an interest in the international market. And I think it's going to take 2017 to happen again when the international stocks outperform with a 27 return when the US stocks did a 21% return. But it was disappointing to the investors when the international stocks experienced a negative 14% return in the very next year. So should you invest in an international index fund? Let me know in the comment section down below about your thoughts on it, or consider joining my private client program linked in the description below.